Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. It's the start of September, the weather has turned, summer is all but over. Will autumn bring a change of season for markets too? Today we start the show by looking at one region for which sentiment has already shifted back and forth this year. Our big read this week is all about the standout performers in Europe, whose sizable stock market returns at the start of 2025 have been followed by renewed political and economic concerns in recent weeks. Chris Akers is here to talk all about the winners and losers in the block, and Julian Hoffman will give his thoughts too. After that, we are talking about investment clubs, a long-standing feature of the UK retail investment world. But does a move by Interactive Investor spell the death knell for this beloved institution? Holly McKechnie will discuss these developments later on. Lastly, we turn to AIM-listed Uniphar, whose shares have doubled this year. Mark Robinson is here to analyse the company's half-year figures and ask what lies ahead for the Irish pharmaceutical. We start, though, with European equities in particular. Chris, you wrote the feature. Why don't we start by setting the scene a little bit, just talking about the positives and the negatives we've seen this year in the context of Europe as an economic and political institution?
Yeah, sure. So I guess the background for this is after more than a decade of dominance by American equities, European shares have actually sort of heavily outperformed the market this year. So Europe's main market index has made a total return of almost a fifth this year when looking at things in sterling terms, against a very muted sort of 3% return for the S&P 500. So it's actually quite a stark outperformance. And that comes as Europe has started to take action in key areas like boosting defence spending, making moves to improve the integration of capital markets. And at the same time as that's been happening, investors have obviously been concerned about US tariffs, the Trump administration's sort of general approach to global trade. And while the US leads obviously on AI and tech, I think Europe's actually been helped by the current debate around a potential AI bubble in the US and US market concentration. So I guess that backdrop, it raises questions for investors about whether this outperformance means there are good opportunities available in the European market, given Europe's much lower valuations against the US. But as we'll come on to, the outlook isn't all rosy for Europe. There are things going on in France at the moment, which we'll discuss, which highlight well, actually, the sort of types of political and economic risks that European investors need to think about.
At the same time, we will get onto some of those bigger risks, as you say. At the same time, it's not all kind of reflected glory, is it? There are some signs that Europe is starting to engage in a bit of self-help as well when it comes to the kind of things that people think the continent or the Eurozone at least needs to do if it's going to start firing on all cylinders again.
Yeah, that's right. So one thing I mentioned there, capital markets integration. There's also work being done on banking reform, trying to boost securitization markets, which is something I get into a bit of detail in the feature. And also looking at ways to boost more retail investor participation in European markets, which is very weak compared to the US. So there are various things going on, which if successful, would really boost Europe in the long term.
And let's talk about Germany and the stimulus plan that attracted a lot of headlines earlier this year. That followed on from, well, the big context is clearly defense and the Russia-Ukraine war, but also it's about infrastructure as well. Can we say a little bit about what Germany is trying to do there?
Yeah, of course. So Germany's Eurozone's largest economy. So what happens there is obviously key. The country sets out this new stimulus plan, and that involves modifying previously sort of ironclad debts and fiscal rules in order to boost infrastructure and defence investment. It's spoken about 500 billion euro infrastructure funds. So it really is a sort of historic change in approach from Germany. As I mentioned in the piece, though it's all about delivery now rather than rhetoric. So Germany has this very big plan, but yeah, we need to see progress on the ground, I think. And some important backdrop for this debate is the Draghi report, which came out last year. This was written by former Italian Prime Minister and head of the European Central Bank. And that report, I think, should be viewed as a big wake-up call for Europe. Draghi urges sort of very radical reforms, huge levels of investment to confront what he calls an existential crisis, or existential challenge, for Europe. And he really gets into the issues Europe faces on how it's fallen behind on innovation, particularly on tech, its weak productivity growth, heavy regulatory burdens, weakening demographics. And all these issues are very challenging for Europe, I think, at the moment. Draghi calls for additional investment of 750 to 800 billion euros a year to drive progress in areas like digitalization, decarbonisation, and defence. So I think the German move should be seen in that context.
Indeed. We'll talk about some of the issues in a moment, but why don't we quickly pivot to earnings season? First of all, talk about some companies, which is a big part of the piece, clearly. We've just had the majority of interim earnings season been and gone. What did that look like for Europe in absolute terms and also in relative terms compared with elsewhere?
Yeah, so Q2 earnings growth was actually better than expected, both in Europe and the US, although it must be said that forecasts were quite low ahead of earnings season. In Europe, banking stocks were actually particularly strong performers, and that's been a strong sector, which we'll come on to in a bit more detail. More generally, European performance this year has been driven by defence and banking stocks. But I think it is important to note that the growth rate outlook for earnings is actually more positive for the US now for this year. The consensus is for flat EPS growth for Europe's main indices for the rest of the year.
Yeah, and one epicenter of issues over the summer is France, as we've touched on. Can we talk a bit about what's going on there? We've got a confidence vote next week. The government might fall, but that is the political side of things, but the economic side of things is really partly what's causing some of this stress.
Yes, so as we're seeing at the moment, bond yields are obviously rising everywhere, but investors are pretty concerned about the fiscal situation in France. Long-term French government bond yields have reached levels last seen during the Eurozone crisis, so that's a pretty serious thing to see. You have the confidence votes in Parliament set for the 8th of September, and the government does look like it's set to fall. So the current Prime Minister, he wants to cut the deficit by around 45 billion euros through a mixture of tax rises and spending cuts to address France's pretty painfully high deficit. That was about 5.8% of GDP last year. French government spending soared in areas like pensions, health, infrastructure, and it's a very difficult political challenge to implement reforms to actually address this. And I think the situation actually raises or highlights common criticisms of Europe quite well, in that sort of it might indicate that Europe's social spending model is unsustainable, very challenging politically to actually fix this. So I think this is a good example of something investors should be looking at when they're considering European markets.
Let's touch on Germany a little bit more briefly too. The economy there has also been stuttering, doesn't have quite the same structural issues as France, perhaps. There were some figures out earlier this week as well, some PMIs revised downwards, so still struggling somewhat. Julian, I know you spend quite a bit of time in Germany, and you have done the past couple of weeks. What's your sort of take on the economic outlook currently?
It's interesting, Dan. If you're in the public sector at the moment in Germany, or if anything is publicly funded, then it's being repaired. I don't think I've seen in the sort of 40 plus years that I've been going backwards and forwards to Germany, the simultaneous work on everything from roads to bridges to autobahns. I mean, everything is, it seems like if you've got a shovel-ready project that is now being funded, which is clearly good for businesses who are leasing equipment or kind of local, the local infrastructure in certain areas.
Mm.
The warning signs, though, are more like political. The coalition there is made up of the CDU and the SPD, which is the traditional power bloc parties in the country, and they're already starting to squabble about spending priorities. And the worry then is that will this filter through into delays in decisions on defence spending, on actually getting digitalization through. If you've ever had to use the internet in Germany, it feels like it's kind of steam driven by comparison with here. So there is hope, but there's also a certain amount of cynicism on the ground that very much will come of it. But the spending rush is definitely having an effect. I mean, you can definitely see that the government is getting on with stuff. But if they start squabbling and they're likely to fall out over welfare reforms, then it could be another long 3 years before the next election. But everyone at the moment is essentially looking for a job with Rheinmetall. That seems to be the only growth company in the entire Federal Republic. So you're some sort of that poor downtrodden car worker who's been laid off, and there are a lot of those. Everyone's trying to build tanks, or at least get a job building a tank. That seems to be the growth industry at the moment.
Well, on the subject of defence, clearly there's been a big run-up in defence shares this year for obvious reasons. Chris, I know you talk about this in the piece as well. What do you see as the outlook for that sector? Because a lot of money, as Julian just said, is clearly being funneled in here. Share prices perhaps up with events, or is there more to come?
Yeah, there's definitely a big debate to be had here about whether European defence shares are now too expensive or whether if there is further to run. Talking of Rheinmetall, it's just opened the biggest ammunition factory in Europe. It's a key name in this space. It is. That's a good example of a company that's now very highly rated. It's trading on almost 40 times forward consensus earnings for next year. So it's like a pricey tech stock. It's difficult. So on the one hand, the sector is going through this very historic shift in spending and changing priorities. On the other hand, you have these chunky valuations to think about. I did write a feature on Rheinmetall earlier this year where I argued that the valuation is justified, sort of given the company's centrality to this European defence play and looking at its order book, etc. I think Rheinmetall probably is still justified given that, but there are good arguments on both sides of that. There are other German defence options available, which the piece mentions, but valuations there are still running over 30 times forward earnings, so still quite pricey. Cheaper options in the sector are available though in countries like Italy and France. One I'd point to is Leonardo in Italy, which is under 30 times by comparison.
Yeah, and nowadays that's relatively cheap, as you've been saying. You talk about a lot of different sectors in the article. Can we, just to wrap up, touch on maybe one or two where there's some areas of interest or companies of interest more specifically?
Yeah, so other than defence, European banks is definitely a sector I'd point to. As I mentioned earlier, it's also been a notably strong outperformer. Given growth prospects and sort of relatively cheap valuations, I think there are still good options available here. I mean, it looks like the rate cutting process is complete for the moment, which is something to bear in mind. The feature points at companies such as UniCredit, Banco Santander, and if people are thinking about German exposure, that's available through a stock like Commerzbank as well. And just on valuations, I mean, European banks are the second cheapest sector in Europe. It could benefit from Europe's plans on securitization, which is something the piece discusses. So I think banks are a key sector to think about. Another one, which was mentioned by quite a few people I spoke to for the feature, is healthcare, which has not been a good performer, but valuations are very low. The piece touches on how Novo Nordisk has done. It's not been doing well, obviously, against Eli Lilly. But I think that's a company to think about. Gillian actually wrote a piece recently on that company and sort of how its prospects are looking under its new chief executive. So healthcare on a sort of valuation basis could be another sector to look at too.
Well, as we say, that is our big read this week. That is the cover feature on the magazine. So do have a look if this discussion has whetted your appetite. We are going to talk now, though, about investment clubs, a topic that is certainly close to a lot of our readers' hearts. It's a topic we covered a couple of years ago in detail, and there's reason to look again more closely this week because frankly, the options are running out for some of these investment clubs, as we'll get to in a minute, Holly. But for the uninitiated, why don't we start by just outlining what a club is? Because in some ways it's self-explanatory, but when you think about the administration required, there are certain foibles and complexities to take into account.
Yeah, so essentially, a share club is sort of, like you said, what it says on the tin. It's a group of retail investors, often friends or relatives, who run a share portfolio. Sort of the members will research the different shares, they'll debate them together, and then make collective decisions on what to buy and sell. Practically, how it works is that so everyone maybe contributes a prescribed amount to that portfolio, and then it's held via a platform with an investment club account. And that differs to an individual account in the sense that while you might have one person nominated to deal with all the admin and things like that, everyone's names are on the account and the assets are held jointly. And I guess that means that it makes it harder for somebody to run off with all the money if you just give it to one person. And yeah, these clubs are very sort of long-standing institutions a lot of the time. Some of the readers we've spoken to recently have been with their clubs for over 20 years. There's a really big sort of social element to a lot of these clubs.
Yeah, and the issue at hand relates to interactive investor. What have they said specifically? I mean, in short, they've said they're going to stop providing the infrastructure or accommodating these accounts on their platform. That is quite a big issue because they were pretty much the last platform left who offered this service.
Yeah, exactly. So interactive investors sort of written to investment club account holders and said that although those accounts are going to be closed from the 27th of October this year, they've not really given a particularly detailed reason as to why. They've just said that the decision was taken as the result of a strategic review. They have offered a couple of options to investors about how they might want to move forward. So they've said that they could either transfer the investment club portfolio to individual club members, trading accounts, so everybody, I guess, just splits off in that sense. They said they could either then withdraw their assets and transfer to a different platform, but as you've said, there's very limited options to actually carry that out. They said they could sell their assets and then, I guess, divide the proceeds, or they've highlighted that they do have a share gift option where they could donate their assets to charity.
Well, it's interesting, isn't it? Because II was the last bastion for these clubs, partly as a result of various mergers that have gone through over the years, buying things like the Share Centre and things like that. From the platform's perspective, clearly there is complexity here. There's also, I believe we've touched on in the past, things like anti-money laundering concerns, which is something you have to think about when you have all these accounts in one hub, as it were. At the same time, I mean, clearly it would be a massive shame if these accounts cease to exist entirely. So we would very much encourage platforms to offer them, I think, wouldn't we? Are there other options out there? As we've implied, there aren't really. We are looking into it as we speak. There are some semi-workarounds, but not really a perfect solution, seems to be the current state of affairs.
Yes, sadly, that's correct. At the moment, options are very limited. Most of the major platforms don't offer investment club accounts. Those that do, such as Hargreaves Lansdown, will still host existing accounts, but they're not accepting new applications. Some sort of platforms have told our readers that whilst they're not currently offering them, they are monitoring demand. They can see that there's potentially a gap in the market there. But again, that's not really a solid confirmation. And I guess the worry is that by the time a platform opens these up, you've already gone and sort of closed down your club and disbanded, and it'd be difficult to set up again. Some of our readers have sort of reached out to some of the smaller stockbrokers who have sort of potentially expressed an interest in holding investment club accounts. The issue with those of A, they've not been confirmed, but B, they've also suggested much higher fees than some of the more mainstream platforms. So it could become sort of prohibitively expensive, I guess, to run those when this is meant to be a sort of fun social club often. And obviously the aim is to make money, but it's maybe not the only goal. So if it becomes too expensive, that might also stop it. Some readers are sort of looking into setting up a limited company instead of an investment club, because a lot of platforms do offer limited company accounts, but that is much, much more complicated. And then you have to sort of get into comply with different company legislations and things like that. So that, again, in lots of cases, just won't be the right option for your club. And then I guess it's sort of looking, if you can't have an investment club account and you can't do an investment club in the traditional sense, what are your other options that are a variety of different, obviously we've seen the rise of sort of social media and different online forums as a way to sort of collaborate with other investors, but obviously then you sort of lose out with that in-person element and that sort of collaborative investing element. You do have organisations such as Signet, which is the UK's national network of individual investor groups, and they sort of meet up and discuss ideas. But again, you don't have that shared account element. So yeah, maybe a more social option than sort of sitting online, going on a forum. But if you're sort of looking for that collective investing, then again, that doesn't quite fit the bill there. So it's tricky times for investment club members.
Indeed. I mean, I wonder if, all else being equal, if the infrastructure was there, you might end up seeing a slight increase in interest in this kind of club, because it is if you're interested in investing, it is a nice thing to do to not even putting aside all the social aspects, which I'm sure will be very nice too, but just to bounce ideas off other people in person and have these kind of conversations that are much harder to do online, certainly much harder to do in big groups. So maybe that's a trend that could continue were there a place for them to do so. I think last time we checked, there were 2,000 clubs on Interactive Investor, but that was a couple of years ago.
Yes, that's correct. So yeah, it's around the sort of 2,000 mark, and they have said that they have seen like a steady decline, which is the issue. But yeah, I think from speaking to readers, a lot of the platforms are open to having a dialogue about investment club accounts. I think their impression, I guess, has been that because they've seen a drop off in investment club accounts. But I think if it is something you're interested in or that you've been affected by this decision, it's definitely worth getting in touch with your platforms and expressing an interest, because I think that at the current moment, their position is that there's not really a demand, and because they are more difficult to administer because of the sort of anti-money laundering legislation that we've touched on, the sort of admin burden then sort of outweighs the benefit to them of running them. But if there is a real demand out there and people are willing to voice that, then I think, I mean, there's no guarantees, but some platforms might be receptive to looking at workarounds.
Indeed, well, you're right. It was very much wishful thinking, perhaps, for me talking about a future resurgence, because these trends, as with a lot of non-online things nowadays, are certainly pointing in one direction right now, but people making their voices heard can help. And we would certainly also very much encourage platforms to offer this service, and even encourage Interactive Investor to change their decision, I think, because it really would be a crying shame if these clubs couldn't continue in their current forms. We are going to keep monitoring this subject, and we'll be writing about it in the days and weeks ahead as well. For the final section today, though, we are talking about an AIM-listed share that has doubled investors' money already this year. It's Irish pharmaceutical Uniphar, Mark. Why don't we start, for those who don't know, to talk a little bit about what the company does precisely, what divisions it has, and then we'll get into the figures and so on.
Yeah, our potted history. I mean, it goes right back to 1967, and at that point it was acting more or less like a cooperative between about 50 pharmacies in the Republic, and it grew over time. And really, when you look at it, apart from, we're obviously looking at the results today, in many ways it's a story that links to the evolution of supply chains, not just in relation to the medical sector, but Europe as a whole. It's broken into three separate groups: pharma, medtech, and supply chain and retail. The Irish economy has been synonymous with the supply of bulk pharmaceutical products in the past. What Uniphar do is something slightly different. It's more, I was going to say, it's a distributor, but it goes well beyond that as well. You could say at the moment that it's matching, actually, when you go back to its very beginning, it's matching suppliers with retail channels. And now it's gone much further than that as well. It's acting as a wholesaler. But again, part of the service that it offers is just trying to find the right products for the right companies. And, that, as I mentioned before, it extends beyond pharma to medical device companies now as well. And when you look at the history of the company as well, it's made dozens of acquisitions to build through the years, but now it's focusing more on organic growth, which is to be expected. You would expect that organic rate to click up over time because you just can't keep on buying companies. But yeah, it's really interesting insofar as it does mirror the changes that are going on to supply chains across the board, really.
And let's talk about the figures, which, as you would hope for a company that has seen its shares go up 100% this year, were fairly decent in and of themselves. I mean, what did we learn there? And also, what does it tell us about why the shares have risen so much over the past few months?
Well, I think the financial performance was passable. The pharma sector was the standout performer, but when you're looking at adjusted profits, they went up by 2.8% at constant currencies to just under 57.5 million euros there. Now, the significance of that is they've got a target in place for 2028 of 200 million euros, 80% of which is supposed to come through organic channels. Now, we cast a certain amount of doubt over this figure, whether they'd be able to achieve this in-house without further recourse to M&A, and we stand by that. And in fact, a note's just been published by Deutsche Bank as well, which makes this point too. But it was a good set of results, and I think part of the reason why the shares have expanded so much this year is that they were underrated in February, looking at consensus targets and whatnot, and the multiples too. They were underrated then. I did wonder actually, because it's got a dual listing, and I've always been sort of interested in this anomalous pricing you can get between dual listed companies, but not to the extent it's not indicated by the extent of the price rise since then. But pleased to say we got on the right side of it, which was good. I guess part of the reason why the outlook is fairly rosy is that the group's engaged in it's actually engaged in the completion of a new distribution facility in Ireland, which is going to more than double the existing capacity. Now, this is going to enable the group to scale up that global pharma platform. And obviously, when you look at the American market, for instance, there's huge opportunities there. Now, off the top of my head, I don't know if there's any similar companies engaged in this space, but given the size of the market over there, it's not surprising that the decision was taken. At the moment, they're actually fitting out the facility itself. Presumably, it's going to be one of these highly digitalized affairs with a low number of staff members working there. But they hope to commission it next year, and it'll certainly help towards them achieving that 200 million euro goal. But it may take a little while before the full benefits of that development come through.
Indeed, you are right. We should flag the buy call you made. We never advocate timing the market, but you did pretty much pick the bottom for the share price, and since then it's all been plain sailing. That said, there are a couple of other headwinds or potential headwinds, or one we should talk about, which is tariffs, pharmaceutical tariffs. They're still very much up in the air, but given this is a European business looking to the US to an extent, that might be something to be wary of.
Yeah, without a doubt. I didn't mention it in the article, and there seems to have been some resolution, albeit temporary, between Washington and Dublin. But of course, the fear is that general tariffs on pharma products that has major impacts on the supply chains itself and production costs, and general market dynamics as well. So, it stands as a sort of a potential bugbear for the investment case itself. But I mean, they're not alone in that regard. And given the centrality of the pharma industry to Ireland's economy, you would imagine that representatives will be going out of their way to accommodate Washington on this score. I mean, I'd be very surprised if people become so bloody minded that they let this sort of issue fester. But that's just my view of it as well. And I would say when we did put the company on a buyback in February, it did seem like a bit of an open goal at the time.
Well, now it's slightly more nuanced, and perhaps for all the reasons you've just spoken about, that is evidence for why we have shifted them back to a hold, in short. Yeah,
well, I suggested that our readers take profits because it was just so ridiculous. I think the shares went up from about £2 to, I think today they're at 357p. So, it's one of those instances. And I looked at the various multiples as well. The price to book is at 1.6, and a PEG ratio at 1.7. These aren't particularly exaggerated given the sector that it's moving in. Now, whether you think that it's a pharma stock or a distribution stock is open to debate. They're not. It doesn't point to undervaluation, at any rate. So, I mean, perhaps the efficient market hypothesis has been brought to bear.
I should say, actually, we've moved them to sell, but very much based on that taking profits basis rather than anything about the operational performance of the company. Anyway, that brings us to the end of today's show. Unfortunately, we've run out of time. So thank you very much, Mark. Thank you to you. Thank you to Holly, to Julian. Thank you to Chris and our producer, Maddie Apthorpe. We'll be back next week with another Companies and Markets show.